The average property from construction start to completion is 22 months in the United States right now. Understanding, like when properties start and when we're anticipating them to be completed, I think that's kind of the best gauge in terms of understanding how the market's going to react here kind of in the short term. We've entered a situation in which there's no new condominium being built in the United States, because if you go back to the 90s and early 2000s, there was obviously a lot of condominium construction in the United States. Well, that's all going away. And that demand that used to go to high-end condos is now shifted to the high-end apartment sector.
All right. Welcome to the Digible Dudes Podcast. I'm David.
I'm Reid.
Reid, we had Jay from CoStar on. CoStar Analytics, not CoStar Research. I think I had his title wrong at first, but he corrected me before we got on air. First impressions.
Smart guy, super knowledgeable, very friendly.
I was surprised. I mean, I knew CoStar had a lot of like analysts and I guess researchers, as they call it, because we had back in the day when we were working with ALN and some others, we had known that they had, I don't know, like 300 or 500 or something people like calling apartment buildings and clarifying. Obviously, CoStar has advertising relationships with the majority of the industry, so they don't have to call around as much. But I knew they still had all these people that were driving by. I remember they have a plane that like flies over every city and looks at like new construction and researches it. So I knew about I remembered that after he mentioned that they had 40 analysts that were like writing reports, but it hadn't sunk into me like that they still do it. I guess that way.
Yeah. I didn't know about the planes.
Yeah. So I guess like maybe it's similar to like us, where I often will say internally that we don't get credit for all the extra work we do. I don't know that CoStar gets credit for all the extra research that they do. Like meaning having this, Jay having 40 people under him that he meets with to talk about their market and how they're, what they're pulling out of it. I mean, maybe if you're someone that's buying the CoStar platform versus the advertising, maybe they're more aware of the research that you do. But yeah, I just feel like they deserve more
There's
credit.
a point with that kind of, you'd be more concerned than you'd be impressed. And I don't know where I am on that, I guess, curve or gradient, but I was wondering why do you have that many analysts? Is it really needed with today's technology? But if it's proven to be valuable, then I'd keep doing it. If I were making decisions for CoStar. But the surveys, for example, it's like, how much value do you get out of making those calls? Does accuracy go up by 5% when you have the double verification? As we often talk about, double authentication. And yeah, I mean, it's hard for me at this point, I guess, in my career and where we're at with Digible, not to be thinking kind of on the operational side or the business side, which is where I took some of the conversation, some of the questions. But the same thing for us. Sometimes when I think about all the work that we do and that we don't expose, it's like, well, why are we doing all that work then? Is it improving the performance of our campaigns by 20%? Is it somehow improving culture? Is it improving retention? Is it improving strategy, which is a very vague thing to say? So yeah, I mean, you, to me, almost as an operator, don't want to have too much of that story going on, because then it probably does mean that you're spending more effort than you need to in areas of your business. And I just want to qualify, because I'm going to assume that Jay will listen to this, that I'm not suggesting that with CoStar. I couldn't help but question that when I heard the amount of analysts that they have. But obviously they must be doing something very, very well, because they are killing it.
Well, yeah, I think Digible's in this current period where we're wondering if all the work we're doing is providing value. It's like, what is the outcome we're hoping to do by doing another blog post on Minneapolis, right? And so that's why we're why it comes to mind. But it also, I guess, maybe organizationally, to your point, when I was at Verizon, the research department, I think I saw it turn over 3 times. Like, because it was like, all right, we need to make this office a little bit more profitable. Do we need research? we can move on. And then like
Mhm.
then they're like, no, actually we do need research. And so there were like I remember 3 different folks coming in and out. And even when we were at the Post, I remember we had
Mhm.
quite a bit of turnover there. So it's almost like we often talk about how marketing is often gutted first, but I also feel like research is almost maybe is it hit as often as marketing is hit.
Mhm.
So it's a tough biz, but also just shows like Jay's impact, the fact that he's been doing it for over 20 years and with such high powered companies. The other thing that got me there was, if you remember, like when we were working with ALN, they started sending us all these weekly reports about the market, and I feel like they must just have been trying to model what CoStar was doing with the market. Yet, to your point, like CoStar's got like they're hardwired into a lot of the data, versus poor ALN, doesn't have that advantage, and so they're
Mhm.
doing all these surveys. And
Mhm.
then I know you're always one that's like, well, the quality of the data sort of indicates like the quality of what you're going to get out of it. So if it's all survey data, do you trust it? Which then means, is it worth even doing? So it's tough gig. But I love the conversation with Jay. I love how he is willing to just roll with us on whatever questions we have. And I also learned quite a bit about, um, I guess, the luxury apartment industry and how it was really a transition from condos to luxury apartments back in the mid 2000s. And then, what he's seeing now in the market as far as like how luxury is, which makes sense that it would take 15 years. But after 15 years of really switching from condos to luxury apartments, and now we're starting to get um, overbuilt in some areas, and with prices already have gone as high as they are, that now means some of the new developments are up against it. So it's really interesting when you look at it on a long time scale, like what Jay has been looking at, what
Mhm.
you can learn.
Mhm. And he did share some of the I guess the history and value that he got out of seeing 2008 and even 2001, and that took us down a interesting thread about yield management and how much asset managers and kind of the higher end operators that they're seeing challenge right now, how much they're going to trust that technology versus, as he put it, hit the override button, which
Hmm.
I think is going to be super fascinating to see.
Yeah, specifically on yield management, just saying, hey, does it, his, I think what I took away was his sense is that it's not as, you know, I, I don't want to use the
Dire,
yeah, like it's like is the wealthy person buying a $5,000 apartment or renting one? Are they really going to be sensitive to getting an extra month off?
right?
They're probably
Yeah.
going to buy or rent
Regardless,
anyways.
yeah.
Yeah, so some really good conversation. I learned a lot from Jay, and it's good thought exercise. So, all right, well, hope you guys enjoy it. Okay, welcome to Digible Dudes Podcast. We are here with Jay. Jay, why don't you go ahead and introduce yourself and what you do for CoStar?
Thanks a lot. Hi, I'm Jay Lybik. I'm the National Director of Multifamily Analytics for CoStar, which means that I pretty much look at the national multifamily market and what makes it tick, and then kind of how that trickles down to the different regions and different markets in the United States.
Cool. Jay, we didn't get to ask you this ahead of time, but do you get to pick your content or what you're looking into? Or is there like a set schedule of like, oh, every spring we do this research project or whatever, and every fall we do that thing?
It's really fun because there's really not that much of a set schedule besides just kind of on a quarterly basis. It's kind of just where the data leads you to. So that's one of the cool things about my work is that I feel like, every day I get a chance to kind of see where the data is leading us.
Yeah. Cool. Well, where did it lead you most recently?
Most recently is the differences that we're seeing in terms of performance at the top end of the market. And, that's where the vast majority of the new supply is coming in. And that's where we're seeing the greatest amount of weakness in terms of rent growth and in terms of vacancy rates rising the most. And in the second quarter of this year, we saw what we refer to in CoStar as our 4 and 5 star properties, which are your high-end luxury properties. The asking rents went slightly negative, and then we saw that negative year-over-year rent growth continue get worse in the third quarter as the vacancy rate in that 4 and 5 star class has gone up to 9.6%. So very interesting to see that, one price point has gone negative in terms of its rent growth. And, that's a pretty significant story because that's such a very important asset class in terms of investors and a large amount of renters, rent in that space.
Quick question on that. How predictable would you say that this trend was or is? Because I feel like depending on who you talk to, some seem caught off guard and others are like, we knew this was going to happen. But I feel like there's kind of a bit of a scramble happening right now with, in particular, those luxury, owners. So yeah, just from your perspective, was this super predictable somewhat or caught you by surprise as well?
To me, it was very predictable, but I agree with you. I think that a lot of people in the industry were not thinking that this was how it was going to play out.
And why do you think that is? If for you it seemed pretty obvious that the owners and operators maybe didn't see this coming as much.
Yeah, well, mostly because of my experience. So, I've been working in the sector for almost 25 years, and a large chunk of that I worked for a major REIT. And while I was working for this REIT, we completely fashioned our portfolio. We were very much focused on class, what we in CoStar world would be 3-star class B, suburban garden walk-up assets scattered throughout the United States to become more of a more focused on infill, urban, high-rise and mid-rise type product. And in my work with that portfolio, I saw very early on that, this is a very different beast than just talking about overall market trends and the like. And so it really kind of heightened my focus on understanding the differences in the price points and the differences in the profile and how that all impacts performance. And so it was kind of like I was already had already worked that part through my research psyche. And so I think that there's a lot of owners that just really hadn't seen that evolution and understood how that evolution was going to impact where we are today.
Got it. One quick follow-up then. How predictable do you think the future is? You mentioned 12 to 18 months offline when we were just kind of asking about timeline that your team and it focuses on. So do you feel like it's pretty clear what the next 12 to 18 months, what the climate's going to be, like more of the same, or are you anticipating some significant changes?
No, I think 12 to 18 months, we have a pretty good understanding of where things are going, without a doubt. And really what's driving that is the construction pipeline. And, it on average, based on the analysis that we've done on the construction pipeline, the average property from construction start to completion is 22 months in the United States right now. So given that, understanding, like when properties start and when we're anticipating them to be completed, I think that's kind of the best gauge in terms of understanding how the market's going to react here kind of in the short term of the next year to year and a half.
Which you're saying is going to be more or less what we're seeing now.
Absolutely. Yes.
Okay. Yeah. That's what I was just trying to get clear on. Okay. Thanks.
Well, Jay, let's back up a second. You told us offline that when you got into the space, you said over 20 years ago that there wasn't as much of a thing called luxury as there is today. Could you give us a little bit of a history there of what has changed over your time in the industry, and as much as you can point to, why and what the impact is? That'd be great.
Yeah, I mean, so I think that when we look to like the 1980s and the 1990s, for the most part, the industry was focused on building suburban garden style properties. And as we moved towards the end of the 1990s and into the 2000s, we were starting to see this kind of shift in terms of a desirability of people to live in high density locations returned to the city, and developers started to then build product that was very focused on those types of locations. And the product then that they were building was, higher end, true luxury, because, there really isn't, when you think of a garden style property, I mean, that's not really, you can have a new garden deal, but to me, you can never really have a luxury garden deal. Not to the extent you can when you have a high-rise product or a mid-rise product, in terms of the amenities you can offer, in terms of the lifestyle that you offer, the views, all the things that come with living in like a beautiful high-rise, in downtown Miami, or living in a beautiful high-rise in downtown Chicago. And so what we've seen is that, over the last 20 years, as the construction has been very focused on that product in those types of locations, but even in suburban locations, the vast majority of the product that's been built lately has been more mid-rise, higher density type of product. And so what's happened is that we've created the luxury space that didn't exist before. And at the same time, we've entered a situation in which there's no new condominium being built in the United States, because if you go back to the 90s and early 2000s, there was obviously a lot of condominium construction in the United States. Well, that's all gone away. And that demand that used to go to high-end condos is now shifted to the high-end apartment sector. And so we have kind of this shifting in this creation of a class that really didn't exist before.
That's super interesting. From your recollection, when did this transition from, let's say, high-end condos to high-end apartments happen? And then do you remember, was it hard at first for those luxury apartments to gain traction? Like, was it like at first, like, shoot, why, who, first mover here was like, seems sort of crazy or not?
Well, I think that, listen, the real, where the real stake in the sand ended up was when the condo market crashed, say like, 2006, 2007. And, you ended up in situations where you had a lot of condo buildings that were either on the verge of being completed or close to being completed, that were then converted to apartment living. And I think that people started to see that, that offered them the type of living that they wanted, with beautiful amenities and beautiful units and wonderful kitchens and, granite countertops or quartz countertops and high-end appliances, without having to take on the risk that owning a condo had associated with it. And then, we all know the horror stories of people who had bought, condominiums, in 2004, 2005, and into 2006, and the impact that had on them financially, in terms of projects that collapsed, in terms of financing, and in terms of, not being able to complete, and left with, they had paid top dollar, and then the condominium was only worth, half of what it was, ended up being worth. And so, there were a lot of factors, I think, that played into people seeing the great advantages that you had of renting versus owning, and you could still get the same type of amenities, you could still get the same location that you have in a condominium, but it just made it a better financial arrangement for yourself than having to own.
That's interesting. I wasn't aware of that. Like, I wasn't in this industry at that time, but I can understand how that may have happened. I was here in Denver when when there were some local laws that changed things for condos that caused a similar smaller thing just in the Denver area. But when you talk about the crash, is that what you see happening now? Well, I guess I should back up a second. My understanding why we have so many luxury properties being built now is that respectively, it's not that much more expensive to build a luxury apartment, but the rent that you can recoup from a luxury apartment in, let's say, the last 5 years was way outweighed the cost of building the luxury property, if you get me. Like, it basically had a better return on investment to go luxury property than not. Is that accurate or to your understanding?
It's part of it's part of what's going on. The other thing is, it's in order to justify the cost, in order to justify the project, you have to be basically charging the highest rents you can. So it's a little bit of a chicken and egg situation, but in the end, because the cost of land, the cost of building materials, the cost of labor, and the significant amount of costs associated with soft costs in terms of permitting, in terms of approvals and the like, you really have to go after the top. You have to be able to be pretty much charging the highest rents possible to make the returns work.
So then that leads me to the question I started to set up, which was, do you then see that there's a type of crash, if you will, happening then for luxury, as Reid was asking you, the next 12 to 18 months, we're just overbuilt, let's say, on the luxury end, and then how do you think that shakes out?
Yeah, I wouldn't say crash so much as is that we're going to have a decent amount of excess inventory that's going to have to be soaked up over time. And what's really interesting is, and I look at this closely, is looking at the demand by the different price points. And we continue to see decent demand for luxury units. It's just not enough demand for the number of units coming online. So because of that, because we do have that underlying demand, I'm not worried about a crash at that price point so much as just that price point is going to continue to feel some growing pains over the next 12 to 18 months.
Got it. I just have two other things, and I'll let Reid definitely pick this up. But one, you had mentioned earlier what CoStar calls 4 and 5 star properties. So how does that get determined? Like, what is setting? Because Reid and I often joke, it feels like every property is a luxury property, and we're like, what does this mean? It's like every pool is a resort style pool. It's like it's just a square or a rectangle. What makes it a resort? So yeah, how does this 4 and 5 star get defined?
Yeah, so we have very specific criteria that we grade buildings on, and that criteria is used across the nation. So what's always funny, having worked in the real estate sector for a while, you'd see a flyer, Class A building in Kansas City, and you're like, no, that's maybe it's the nicest building in Kansas City, but that still doesn't make it a Class A building per se. And so we have very defined criteria that we grade each building on in terms of its type of construction, the amenities that the property has, the down to the type of flooring that the property has, lobby, those types of things are all looked at and examined in terms of when we come up with whether a building's a 5-star property, a 4-star property, or a 3-star property. And those are used across the board for every single property. So there's no grading curve here. So it's not, we're not looking at Kansas City and saying like, oh, because it's Kansas City, this is a 5-star. If you pick up whenever you pick up that building, whatever market is, and you drop it into a new market, it's got to be exactly the same.
Yeah, do developers then angle to try to make it 5-star versus 4-star, or do they not really care?
I don't think they really care that much. I mean, they're focused on the product. They're focused on what a term that you'll hear in the development sector, value engineering. Maybe instead of using 30 millimeters of quartz, they'll use 20 millimeters of quartz. Those types of situations. So, they're not really, in their mind, they're not probably saying like, oh, I want this to be a 5-star property. They have a little bit of wiggle room that they're probably working with in terms of, do I really need Moen faucets here, or can I just use American Standard kind of a situation?
Yeah, just I was in the automotive industry for a time, and the dealerships definitely had if you want to be a 5-star dealer, certain criteria you had to hit, not just from like what you offered, but also the type of service and your follow through. And then that could change frequently. You could get downgraded frequently. You couldn't really get upgraded that easily. And it seems to me like that'd be an interesting opportunity for CoStar, because I think of like Jay Turner with the Aura score, but it's just based on reputation versus like, well, what if we considered like, the class of the building, like you were saying, plus your reputation, and if you could like earn it or lose it. Um, Anyways, in the automotive industry, it really mattered. And yeah, if you got a bad customer review, like, everybody was on top of it versus here, like you said, it's pretty separated. People don't seem to think about it as much.
Yeah, not as much. I think that because, when you're thinking about the real estate asset, it's got a little bit more of it's got a little bit more of a lead time in terms of, how people are looking at it in terms of its newness and in terms of, its wow factor. And I think when you look at, when you think about the automotive sector in terms of, every experience, every time that person comes into the dealership, it's like you're resetting the clock.
Mm-hmm. Yeah.
Well, I'm gonna maybe move us a little more towards business discussion or questions about CoStar multifamily analytics, if that's okay. And I think
Yes.
you can push back if I cross any lines here. But starting with some super high level, what is the vision or goal for your division? And I don't know if that's something you've said or was pre-established before you joined a couple of years ago, but yeah, just curious what that looks like for multifamily analytics at CoStar.
Well, multifamily is a relatively new sector to the CoStar family. So, what really launched the multifamily sector in earnest for CoStar was the acquisition of apartments.com back in 2014, because that gave CoStar, an amazing way to be able to help gather the apartment rent data. And, since then, the multifamily space within the CoStar family has really accelerated, and we have been able to, create, I think, some amazing data for our clients. And, to me, the vision is to continue to try to make sure that our data set is it has the best reflection of actual conditions that we're seeing in the market. And one of the ways that we're able to do that is that, we get 4 times a day, we get data feeds from the apartments.com website into our CoStar product, which then our clients have access to. So you can be rest assured that, the rent data that we're getting and that we're publishing and that we're analyzing is the deepest pool of data available for rents, and is accurate and is constantly being updated. And I think that given that a lot of the institutional product today is on yield management systems, you can't just assume that a rent that you got a couple days ago is still the current rent. And I think that's one thing that CoStar has and continues to build on, and is to me, the cornerstone of what drives the strong data that we have for multifamily.
Yeah. Oh, that's great. And then how's that measured? Would it just be the number of licenses as far as knowing how much progress you guys are making on that overall kind of vision and goal?
Well, I think it's about, the number of properties that we're getting daily feeds on. And,
Okay.
we have a staff of a few hundred. I shouldn't say a few hundred. I mean, it's, hundreds of people in our Richmond office who they are also following up with phone calls to properties in terms of getting more information. So to me, it's kind of like a two-pronged attack. We're getting the 4 times a day feeds from those clients that advertise on apartments.com, and we're following up also with human interaction for properties that don't advertise on apartments.com, and even some that do advertise on apartments.com when we find irregularities in the data to make sure that it's correct. So, to me, it's a huge full court press in terms of getting the data and not just relying on, human data, primary data collection, and internet direct feeds that we get from property management companies that from the firms that advertise on us. It's we're trying to make that net as big and wide as possible, so that when we're throwing that into the ocean to get those fish, we've got the best. We're getting all the fish we can every time we throw that net out.
Totally. And is the access to the data mostly a value add? I'm just getting again at the business side of this, like in the licenses, because David and I, looked at getting a license a few years ago. We weren't in the position once we found out the price to pull the trigger. Then it might be something we could do now. But you're mentioning when somebody's advertising on apartments.com, you didn't say explicitly that they then get a certain level of access to this data that you're providing, but I just wondering kind of how that equation works from a cost, or I'm sorry, productizing it, if you will.
Yeah, well, the products are separate. So,
Okay.
We have apartments.com clients who are not CoStar clients. I'm hoping we continue to work on trying to convert them, but it's the apartment.com clients have obviously their focus is on advertising with our website and generating leads, and the other services that we provide in terms of AI chat, in terms of virtual tours, in terms of the photographs of units and available units, and all the great features that the apartments.com website offers our clients. So that's kind of like, one piece of the puzzle. And then the other piece of the puzzle is, the CoStar side of the table, where, we're gathering the data and creating analytics and creating a platform in which clients can tap into that to understand what current market conditions are, read market reports, have access to all of the local reports that get produced. We have we have about 45 local research analysts who their whole job is to just write about and track individual markets. So it's really kind of it's kind of a two. We've got two separate entities that work together, and we can offer clients what they need if they're focused on the apartments.com for advertising, and that we want to get them to the CoStar side, but that doesn't necessarily always happen. But if we do have a lot of clients who are both apartments.com clients and CoStar clients, and it's kind of like I always say that they're getting the best of everything when they're in that type of situation.
Yeah, makes sense. And I was actually just about to ask you on the regional and local reports, because I would assume that like at the highest level, like there's a much smaller portion of the multifamily industry that would gain value or be interested in that. I mean, I think lots of people want to know, hey, generally speaking, what does the picture look like in multifamily? But the more actionable, data and insights is going to come probably a little bit below that, right? At the regional and local level. And so I was curious, when David asked you, is it predetermined as far as the reports and the analytics that you're going to publish and deliver? You said it was a little more fluid in a good way, and it depends on where things are leading you. So are you in touch directly, or are there other members of the division that are getting that feedback on what's useful and what's not? Because I think for us, we're not running an analytics company, but it is a big part of our culture. And sometimes you'll push something out and you expect everybody to be using it and get a lot of value, and they don't. And then other times it's just the opposite. So I'm curious, as far as the feedback loop, where you see the most usage and value being extrapolated or extracted, where that comes and how that arrives.
Yeah, I work very closely with our local analysts on a quarterly basis. We get together. I actually meet individually with every single analyst at the beginning of the quarter and talk about the trends in their market and how they relate to what's going on nationally, and help them, the question, when they have questions about what's going on in terms of multifamily, help them with, answering that, digging into the data to help them have the best understanding and knowledge of what's going on in their individual markets. So there's a very, very close relationship between my work on a daily basis and working with the analysts that we have in the field who are tracking, the individual markets. So whether it's Dallas, whether it's Denver, whether it's Seattle, I'm in constant contact with them. We're utilizing, teams every day. Someone says, hey, I got this thing, such and such is happening in my market. Is this happening in other people's markets, or what do you guys think? So there is a huge amount of collaboration and a huge amount of sharing of information, top down throughout the CoStar, what we refer to as the CoStar market analytics team. And that plays a very, very important role in the content that's getting published onto our website.
Cool. I'll flip it back to David, and then I'll have a few more questions on this thread.
Yeah, well, it's a heck of a commitment for that much headcount, like diving in and writing reports. You had mentioned offline to us that you said that rent data was your most or maybe most fundamental data source. Did I have that? Did I regurgitate that correct, Jay?
Yeah, no, absolutely. I mean, especially coming from my time on the ownership side of the business, I had a boss, and he was kind of my mentor for the multifamily sector, because I had come from the office and industrial side of the business. And he had a saying for me early on when I started. He's like, the rubber meets the road when, how much are we collecting each month and putting in the bank for each property? And so, you can talk about vacancy, we can talk about, some of the other data points that we like to look at as researchers, but, where the rubber meets the road is how much money are we depositing in the bank every month, and how much more did we deposit this month or less than the previous month. And so that was really drilled into my head early on, starting to work into this sector. And I think that it's really true today. And to me, that's the ultimate barometer of health of the sector, is where our rent's going.
Mm-hmm. Well, it makes sense to me. I mean, Reid and I, when we were on the publisher side, you had, different ad inventory, and you were just trying to get the highest total yield out of that inventory. But it was always a question like, do you try to get more sell-through rate on your ad units, but by dropping price, or do you keep prices high, yet so you have some vacant units that come up, but you maybe end up get a higher total yield. So using that sort of like train of thought, where do you think this goes for these luxury properties? You mentioned like different areas of the country where it's just where we have a lot that will need to get absorbed in the next 12 to 24 months. Do you expect that those folks will end up bringing prices down so that they can fill out lower vacancy rate, or do you think that they will keep prices high and accept more vacancy rate? I'm just wondering, you've seen this more than we've seen it, and our customers always come to us and they only talk about occupancy. And so I'm just wondering, you have better insights on this.
Yeah, so I think I have kind of a little bit of a unique thought process on this, and David, you may find this interesting. I grew up in Michigan, and majority of my extended family worked in the auto industry, and actually my son actually works for a major auto company right now. He's an engineer, and I find as an economist by training, I find pricing and the idea of discounting a fascinating concept. And I love to use car analogies to talk about what's going on in the multifamily sector today. And the reason is, and as we talked about earlier, we have this situation where we have this bifurcation in terms of price. And if we go back 30 years ago, if there was an oversupply in multifamily, the way that you got out of that situation as a developer of the new building was you would just offer months rent free. So you'd say, okay, I'm going to offer a month of free rent or maybe 2 months free rent, and I'm going to pull that resident in the existing garden deal down the street from my property. I'm going to be able to say to them, hey, you could pay less money and live in a brand new property. Why wouldn't you do that? And that worked out really fine back then. But today, because that price difference is so wide, so nationally, the difference in terms of rent for 3-star properties to 4 and 5-star properties is $600 a month. Well, that's a pretty big jump in terms of what you're putting out every month in terms of your housing expense. And whereas before, when we look back when it was mostly garden product that was being built, the rent difference between an existing property and a new property was not that much. It was maybe $100 or $150. So now we've got a $600 a month difference in terms of rent. That's much, much harder to bridge that and try to take, because the old thought process was the way to create demand in the multifamily sector, much like in the auto sector, is you think, oh, well, we just offer rebates or discounts and then we'll create demand that way. And my feeling today is that you really can't do that, because the income levels, the profile of those residents in the existing class, the class B, aka 3-star and CoStar speak, they can't afford the rents in the 4 and 5-star product where the oversupply is happening. They can't qualify in terms of income. So you're talking about an extra $20,000 to $25,000 in income to qualify for those properties. So there's kind of a moat that's been created between the 4 and 5-star and the 3-star assets. And my belief is that by offering concessions at the top end of the market of months of free rent as a developer, and thinking that that is going to create demand for your property, I don't think is really what's happening in the market today, because you can't create the level of demand that you could 20, 30 years ago in terms of pulling up people from older properties or existing properties, because the income, the price difference is too much. And so the analogy that I kind of like to use is that if someone's looking for a Honda Accord and there's a BMW dealership across the street and it says that they have a $10,000 rebate on on a 5 Series, well, okay, so that $75,000 5 Series is now $65,000. The person looking for the Accord can only afford a $30,000 Accord. They're not going to go like, oh my God, I can go get a 5 Series. And I think that I don't think that the multifamily industry has come to that full realization that offering discounts at the top end does not necessarily create demand. And to take that a step further, to me, what that's doing is that's actually taking money out of your pocket, because that person who's going to rent that high-end luxury apartment is going to come into your property anyways. It's about you being able to close that potential resident, as opposed to thinking that they're going to choose your property only because of price.
Mm-hmm. Yeah, well, I love this personal theory of yours, and I agree with it. I think, as you go into like higher and higher luxury items, people are less price sensitive. And so by giving them a month free, or whatever, 2 months free, if they wanted to live there, they were going to live there anyways. They weren't going to care as much about like, oh, I only signed because I got 1 month free. Now, I'm not saying it makes no impact, but it probably is marginal compared to what you're giving away to lease up 300 units and giving so many months free. So how does it shake out then? Like, meaning what, I guess there's a difference between maybe how you would handle this versus what does the group hive mind here of the industry, how do they end up handling this as you see it in the next couple of years?
Well, that to me is going to be the interesting thing to watch. And, especially when you look at, say, the public REITs, they're one of the best barometers that we can look at in terms of what they're reporting in terms of their revenue, because the vast majority of them, their portfolios are very much focused on the high-end luxury units. And a lot of them have very large portfolios in the markets that are currently experiencing the heaviest amount of new supply deliveries. So it's going to be very interesting to see how they continue to report in terms of their revenue and their NOI, given this environment. But looking at what we're seeing in terms of our data from, all the rents that we're gathering and all the other information that we're gathering, one would think that they'll be seeing their revenue definitely be declining. Now, the question is that how much will it decline, and how panicked will they get, and will they think that they need to wholesale slash their pricing? And if they do, it'll be interesting to see what impact that really has on their occupancy and has then on their ability to increase their revenue. But ultimately, I think that it's going to depend on how much they really analyze and think about the things that I just talked about in terms of the differentiation in the market today and their ability to, are they just giving away money to people that would have paid anyways? It's kind of almost like the airline industry in terms of that, are you dealing with a situation in which you can price discriminate for almost every ticket? And I think the airlines have done a great job of, squeezing every dollar possible on that airplane, every seat. And it'll be interesting to see how well the apartment industry, the multifamily industry, handles this situation. Are they going to have fire sales at the top end, or is there going to be more discipline and more of a analytical approach, to this in terms of looking at how they're going to be able to fill these units and, what that means in terms of their pricing?
Reid, I think it was 3 or 4 years ago, Qdoba tried to get people to start coming to Qdoba versus Chipotle, because Qdoba was like, we'll give you guac for free. And it was not enough to make me switch. I was still going to pay for guac. Like that's like that's how wealthy I am here, Jay. I'm not looking at the 5 series, but I am automatically adding guac to my bowl.
To your bowl, okay.
Yeah, but it didn't make a difference for me. But maybe Chipotle did steal some market share because they gave away free guac.
Well, and did Chipotle have a yield management system that was telling them whether the guac made a difference or not? So it is a good segue here for us to ask about yield management. And is it fair to say that the software, these platforms, and there's only a few, as David was saying offline, have not ever seen a climate like this, and so operators almost don't know what to expect from the technology and where they'll what those recommendations may be. And part 2 of that is that what I don't think see now, and I don't believe it's on the roadmap, is that yield management might say, hey, you should be focused more on 6-month leases, for example. Hedge your bets here, or vice versa. Because I think that's one of the things, if I were an operator, I might explore is, in this climate, I don't want to get pot committed to any one strategy. And so I need to kind of diversify a little bit. And that isn't just in my pricing, but it's actually in the terms that right now I'm putting out for potential residents. So yeah, first question is, has this software, because I don't have the exact date, and you might, as we were talking about the founders of yield management for multifamily, but it seems to me it's mostly been in a bull market. Things have been great, lots of tailwinds, not headwinds. And so this may be the first time that this software, if you will, has experienced this climate. So it's super interesting. Like, as an analyst, am I going to just, or as an asset manager, say, well, this is the whole reason that we invest in this technology? I don't know what the heck to do, in a climate like this, or am I going to fully rely on it? I know there's a lot inside of that, but I think you can hopefully run with some of those points or questions.
Yeah, no, it's a great question. So actually, yield management started to be rolled out by a couple of the major property owners before the Great Recession hit. And what I believe we saw was that the yield management softwares for companies that trusted it and didn't freak out and listened, let the algorithm do what it was telling the property level to do. They did not slash rents as much as they would have. And my example of that is that if we look at the 2001 recession, coming off the stock market, the tech bubble bursting, the United States economy lost 2.2 million jobs. And on a national basis, we saw rents decline 4% year over year. Now, we fast forward to the Great Recession. The U.S. economy lost 8 million jobs. And on a national basis, we saw rents decline only about 4% year over year. So we had a much worse economic situation that the industry was dealing with. And yet we saw about the same impact in terms of revenue. So to me, what that was signaling is that for the major owners that were using yield management, the yield management software helped people not give away the farm, because a lot of the property managers at that time, they were incentivized based upon their occupancy. Well, I can keep any property 95% occupied. Heck, I can keep any property 100% occupied. I'll just lower the price. I'll just lower the rents.
Right.
I mean,
right.
that's easy to do. And what tends to happen, I used to see this in my interactions with property management people, was any hint of bad news, they were ready to start dropping rents wholesale.
Mm-hmm.
Let's say it was in Seattle, and the Seattle Times reports, Boeing's thinking of laying off 5,000 employees. All the property managers in Seattle are like, oh my God, we better start lowering our rents.
Mm-hmm.
And what the yield management system does is say, it's kind of like that. It's kind of like being the grown up in the room, for lack of a better analogy, of being like, no, yeah, that's not a good thing, but let's just sit back and let's see what happens, and let's not panic. And so we kind of had this little bit of, we were able to get a taste of that, I think, at that time. And what's very interesting is that, we ended up seeing rents rebound coming out of the Great Recession much, much faster than anyone anticipated, while the economy was still really in the doldrums. And I used to love this. In 2010, a lot of Wall Street analysts and other people in the industry would be like, how can we be having rent growth when there's no job growth? And, we could get into that whole discussion another day, but, to me, the fact of the matter is that the yield management systems were saying like, hey, there's demand out there for multifamily. We're getting it. We don't need to be slashing prices. We can actually start to be raising prices at this time. So I think that the yield management his software has had kind of a trial by fire already, and it will be interesting to see how it plays out. Now, again, to me, the big question is that now it's been rolled out to significantly larger audience today, but the end result is, where the rubber meets the road, is, will the property managers and the owners listen to what the yield management system is saying? Or will Or will they hit that override button and be like,
right.
No, we've got to, this is wrong. We've got to do something else. And so
this will be one of the bigger kind of macro, almost case studies to see how much technology is trusted or not trusted. It's happening in a lot of different sectors, not just real estate. But as far as it's come, are we, like you said, still going to see a lot of owners hitting override? I think one of the bigger differences between 2008 and what existed in yield management and now is there are other options, for owners as you think, short term co-living, you know, different strategies that they could deploy that aren't strictly, am I going to trust yield management or am I going to hit that override button? And it seems like some combination, and I don't have the answers, but you know, where people are going to win, which they're going to explore some different things, hopefully find some angles there in this climate, as well as leaning more into the technology versus their intuition. But it'll be
Yeah, I think
fascinating to see.
and that comes into your point about, in terms of staggering your lease expirations
Right.
and, trying new things and, what that means. Maybe you offer a really low teaser rate, on a 6-month lease right now with the idea that, maybe in 6 months, rents are going to be significantly higher. And once you get that person in that unit, you're rolling the dice and you've got a percentage, you've got an opportunity to keep them, and get them to a higher price than you would have if you had signed a 12-month lease. Yeah, there's a lot of kind of cool things you can try and see what you can figure out.
It kind of reminds me, there was this study on the stock market, and I'm sure everyone's heard of, like, it's more important to have time in market than trying to time the market. And I pulled it up to make sure I didn't get it wrong, but the study was from 2010 to 18, and if you had invested $1,000 and you left your $1,000 in the whole time versus trying to time the market, versus if you missed 10 days or if you missed 20 days or 30 days, and effectively if you left your money in the market the whole time, you saw. Let me pull it up here. You got your $1,000 would have been turned into $2,700. But if you only did 10 days, like pulled out for 10 days, now instead of making 2,700, you're only getting 1,700. And then if you were 20 days, you were, only at 1,200. And then if you missed 30 days in that span of time, you're actually upside down. You actually lost money. So my point with this is, I think a lot of times people try to get really sophisticated, or they think they are. To your point, Reid, like maybe it's like, well, I use technology, but sort of directionally, and then I like use my instinct and gut, and I'm going to monkey with things here and there, and you end up being worse off than if you just left your money in the market and just like let it ride, because you're not really like committing to a strategy. You're kind of like half-ass committing to a strategy,
Mm-hmm.
and it's like you're pulling out of the market for 10 days. So anyways, I think, yeah, I think we overcomplicate things a lot when we could just like, the easy button is like, just trust the machine, follow it. And by the way, you're going to save all these man hours too. Like, and so anyways.
Yeah, it would behoove the yield management platforms to almost remind the owners right now of 2008, if in fact that was a good story and they were able to show, like, with the software versus without, almost like a preemptive marketing or PR campaign. Um, I wanted to come back briefly to the business side of this, but I don't want to use a bad analogy here, so I'm going to just not use one because there's one that's coming into head or coming to my mind. But in a environment like this, does this drive more subscriptions? Like, I mean, if it's like I'm not really sure what to do,
Mm,
wouldn't that then you'd think be a good thing for CoStar Analytics? Um, and I liken this to advertising. David and I have these conversations with owners, marketers, but should they spend more in a distressed market or, in a down market, or should they spend less? And this is another one that it's like, well, ideally I shouldn't be relying on my intuition, instincts, or even, my vendor. I would like technology to help guide this decision. But yeah, same thing with analytics. You see the parallel here, right? It's like, okay, if I'm really confused and it seems like the next 12 to 18 months could be more of the same, shouldn't that drive up, subscriptions for analytics, or are people like trying to cut every cost that they can and it actually goes the other direction?
Yeah, I got to be careful here. I don't want to like say too much in terms of our our potential revenue or in any outlooks for our stock price, but um, you know, I think that there
Well, you can
is.
plead the fifth, Jay, if you want. I didn't mean to.
No, but I think you're right. I mean, I think that when um, budgets are under stressed in these types of environments, and I think it's easy for some operators and owners, etc., to start looking at different line items and thinking that, how much value am I really getting out of this subscription? And do I really need it right now? And maybe I should be pulling back on this. And I wholeheartedly agree with you that, when we're in times of, yeah, when everyone's making hay, it's great, and, but when you start getting that uncertainty, I agree with you completely. I mean, that's when you need the data and information the most, because to me, that's when you need to be able to find those diamonds in the rough the most.
And do your analysts offer, do they stop short of suggestions? So where I'm going with this is, could there be a switch from I'm using yield management, I'm not totally comfortable relying on it, I'm going to hit the pause button there, and I'm actually going to invest, in CoStar Analytics and spend more time with a human analyst to help guide me through this?
Oh no,
Well,
we don't go into that.
okay,
We're
so you
not
do
into
stop
that.
short of suggestions. Yeah.
Oh
Okay.
yeah, that's not our cup of tea by any means. We're not experts in terms of property operations and that type of work. Our expertise is focusing on what's happening in the market, and talking about the drivers of those situations, and talking about the impact at the market level, at the sub-market level, etc.
Yeah. So you provide the greatest intelligence that you can, and then either a platform picks that up, or an analyst and decides what it ultimately means for that particular property.
Absolutely, yeah. Then,
Yep. Yep.
there's many great tools and functionality within the CoStar product that allows you to create, your own portfolio, to be on the track, and you know multitude of fantastic things that give you deep insight that is not that has not our analysts and myself, that we don't get involved in anything like that.
Yep.
But we our clients have the ability and the access to do those things.
So, Jay, I know we're coming up on time here, but one thing we like to do is usually ask someone for their hot takes. So, if there's anything that you have that's controversial that you believe in, we'd love to hear it. But this may be a setup for that in case you don't have one, which is you talked a lot about pricing and how maybe the luxury market isn't as sensitive to it as maybe many operators think it is. So I'm wondering, have you found any correlation or lack of correlation between amenities, if you will, and pricing or location? Basically, like, hey, if this apartment's in Times Square or just whatever, then like it really doesn't matter if you have a gym or if you have a pool. Like it's gonna lease kind of for the same rate no matter what. So I'm just wondering if you've seen anything like that we could take away as learnings.
I was doing some look at, and you may find this funny, but the question of in-unit washer and dryers. And if you have a property with in-unit washers and dryers, do you get better rent growth because of that or not? And so far, digging into the data, it's been inconclusive so far. So that's one that's like really high on my list, because that one fascinates the heck out of me, because that to me seems like a very, very a non-negotiable amenity for a number of residents. And then the question is, like, how much more are they willing to pay for that? And then, can properties leverage that? And I just have not been able to figure out how to get a time series where I'm able to isolate that enough to be able to draw a conclusion. So, and then if I could figure that out, then I could try it for other amenities. To your point, like, does having the resort pool on the roof, does that really matter that much or not? Especially if you're in, say, Boston, in which you can only use the pool for 6 months out of the year anyways.
Yeah. Well, if it's that hard for you to figure out, then it's probably doesn't matter, right? Like if it was like an obvious enough choice, it would be obvious it'd be obvious enough for you to find it, versus if it's like, well, I'm not really sure if it makes a difference, and you have to like dig even further. That's usually what I say to our folks here. So when our folks are diving into stuff, it's like, if you can't figure it out in an hour, then it's not significant enough to matter for us. So that's interesting. All right. Well, what about other hot takes? Is there anything else that that you want to share there, or will you, as Reid said, plead the fifth on that one?
I just think that we're in a really interesting situation where, the Midwest right now is having some markets that are the rent growth leaders right now. And I think that that institutional investors really should take a closer look at Midwest markets. And I think that, there's been this huge focus for a very long time on, the smile markets or just Sunbelt markets as the place to invest. And I think that, if investors maybe kind of looked a little bit deeper and peeled back the onion a little bit more, they would maybe find that, Indianapolis and Columbus and Chicago may be a better market than they think. And that to me would be my one thing that I'm throwing out to the listeners here today, is that, sometimes I think real estate can be a very herd mentality. And I think that's one thing I would throw out, is that, like, maybe everybody rushing into the Sun Belt isn't always the best investment strategy. I'm not saying that Sun Belt markets are bad by any means, but I think that this is an opportunity for investors to maybe take a step back and see that maybe that there's other possibilities and other ways that they could make some decent returns, and not everybody rushing into buying in Austin and Tampa and in Raleigh.
Yeah, all makes sense.
Well, maybe real quick follow up on that, the flip of that. So the dangers or concerns around kind of that hive or herd mentality. What would you say is the best kept secret right now within, market specific?
Well, I think it's the Midwest. I think that, when you look at, Cincinnati and Chicago have been producing some very stable rent growth numbers throughout 2023, and in stark comparison to, Sunbelt locations, like I just mentioned. Austin, and at the end of the third quarter, we had them down almost 5% year over year rent growth on an overall basis. Worse if you're in the 4 and 5 star sector in Austin. So, I think that it's, to me, that little bit of information and the realization that, sometimes when you have that stability, it's not a bad thing. So that's my comment. And that's in my, my belief, and I'm sticking to that one without a doubt.
Cool. Well, I had just one last question. I don't know whether to go MLK on this or Aladdin, but I want to know if you had one wish or a dream for multifamily analytics. What would that be? We opened up that bottle for you.
Yeah, to me it would be, I would love to, I think that better understanding of that high-end renter profile, just better insights into what's driving them, and deciding, what amenities really matter, and what's driving them to a certain property or not, and what's most important to them, because I think it's an incredibly important part of the sector right now. And I just don't know if we've dug enough into what really makes them tick, and what their wants and desires are. And I know dog parks and, dog washing stations and things like that they seem like that they're important amenities, but I'd love to just really understand that try to get into the mindset of that renter profile a little better.
Yeah.
Well, Jay, I'd like you to look into free guacamole and see how that impacts things.
I was going to recommend cryogenic chambers. We've seen that pop up too, but Yeah, I appreciate it. Love your passion, your experience. You're obviously great for the industry and great for CoStar. So really glad that we got some time with you today.
Well, it was great chatting with you guys.
Cool. Jay, if people want to learn more about what your team does or see some of the work, what's the best way for them to do that?
Well, CoStar.com. Hopefully, if you're already a client, you're seeing our the information that we produce on a daily basis. If you're not a client, go to CoStar.com and you can get a contact. You should be able to get some contact information on how to contact a sales rep. And we would,
Cool.
and if you're not a CoStar client, would love to have you, because you will have access to all the things that I was talking about in terms of what I produce and our team. And I think would offer you some fantastic insights into the current state of the multifamily market.
All right. Well, thank you, Jay. We appreciate it.
Thanks.